please. Yeah, so this is me, John Pryor, and I guess the thing you need to know today is that for the last 20 years or so, I've been involved in IP and basically helping business to identify and capture the value in their creativity and innovation through using intellectual property. Next slide, please. So what I want to do today, before we hand over to Caroline for the meat and drink of the presentation, if you like, is to give you a summary of IP business value, and then a quick canter, if you like, through the different forms of intellectual property. Next slide, please. So from the perspective of business value, I've been involved, as I said, for over 20 years, and several of those years, in fact, the last 10 years, have been involved in monetizing intellectual property to some extent or another. So how can you monetize intellectual property? So a European business I work for, we brokered the sale of just their patents, to Apple for $5 million. On the more litigation side of things, I was involved in the sale of a covenant not to sue to Samsung, so they were indemnified from being sued for patent infringement, as it turned out to be, for $40 million. A UK business generating, it says $100,000 per month from licensing their intellectual property. Quite spectacular. Small business, it is possible. I get involved in the buy side as well as the sell side. So I also work in terms of helping businesses to complement and complete intellectual property portfolios, and was recently involved in an acquisition, an IP acquisition. Also royalty bundling. So this has been in the news a lot recently. So particularly with reference to copyrights and musicians, some would say aging musicians, it is possible to take the old music rights or photographic rights or other rights and actually sort of bundle them up and sell them. The future value is sort of captured from a discounted cash flow perspective, and the artist receives a royalty. Famously, this was done by David Bowie quite a few years ago, and then his family did it again in the last year or two. So yeah, interesting ways of monetizing intellectual property. Another side, of course, if you are in a situation where you're looking to raise cash without giving equity away, then looking at your IP portfolio might be an option to raise cash without actually diluting the equity in the business. Next slide, please. So my only point here is that in the last 50 years, business has changed substantially. And so 50 years ago, this is the value of the Standard & Poor's 500. 80% of it was captured in machinery, buildings, materials, vehicles, etc. And you roll forward to, it says 2018 here, but today, and 80% of the business is captured in people, process, platform, code, design, brand, innovation, R&D, etc. It's a really substantial difference, and it does have a difference. It does have some implications in terms of how businesses are managed. So next slide, please. And we talk about this in terms of the quiet economic revolution. So the book, Restarting the Future, by a couple of eminent authors, Jonathan Haskell and Stian Westlake. Jonathan Haskell is on the Bank of England Monetary Policy Committee, and he's the professor of economics at Imperial Business School. Stian Westlake is the CEO of the Statistical Society and has long been a senior researcher in innovation in the UK, for example, at Nesta. Their point really is that businesses, since the turn of the millennium, there's been more business in the UK has invested more in intangible assets. So as I said, brand, design, R&D, software, than it has in tangible assets. And I'm from Sheffield, so here we have a steel foundry, but material, so machinery, plants, vehicles, even computers. There's been more invested in the intangible side than in that latter side. And what does that mean for you and for business? Well, it is a quiet revolution, because if you think of Britain's most famous innovation, most people will think of the phone or the TV or the World Wide Web, etc. But is it actually Harry Potter? And why is that innovative? Well, to me, it's all intellectual property, but it illustrates the point around about the fragility of intellectual property, because it's a book originally, of course, and it then became a film with substantial computer graphics and imagery, and then, of course, the whole sort of merchandising add-on, and it's now a $40 billion franchise, and the author is worth $1 billion herself. So it's a significant business, but of course, as was illustrated in the last couple of years, there's a film that came out in India called Harry Potter, Hari, about a wizard who lived under the stairs. But it was merged into another film, another popular film. And, it just illustrates the point that intellectual property spills quite easily. The spillover component, the fragility of it is really important. And hence it needs to be protected. And that's really what intellectual property is about. Quickly on body pump. Body pump is an exercise form which is done alongside music, and apparently 6 million people each week go along to body pump classes. It was started by an athlete from New Zealand who decided to set up a gym, and then he evolved that gym into an intangible, a brand with a whole sort of intangible set of assets around about the way that music is associated with exercise. Next slide, please.
John, just before you move on, we've had a question through which I think may sort of relate to the sort of your opening slide. So if you don't mind me reading that out, how does a business generate cash value using IP?
Yes. So I've been involved in IP brokerage for many years, and there's some fantastic examples in the UK where people have sold or licensed their intellectual property in the past and generated really substantial sums of money. The market varies quite a lot, but it is eminently possible, and it's something that I don't think people sufficiently understand what they have by way of intellectual property, nor protect it, and then nor value it. But it's certainly worth looking at in terms of what the opportunities are to generate revenue, cash, and also value. I mean, value is equally attributable in many different ways. Of course, there's value because you can exclude competitors from your marketplace. There's value because you can charge a license fee to your competitor, and there's value in sort of making sure. I was blogging yesterday, I don't know if people know this, but when Rolls-Royce sold the automotive business to VW, I'm not sure how deliberate it was or otherwise, but through some dint of circumstance, the trademark for Rolls-Royce was licensed to BMW, and BMW ended up owning and selling the Rolls-Royce car, and VW went on and developed the Bentley brand into what it is today. But I don't think at the time they bought Rolls-Royce Automotive, they thought they wouldn't be able to sell the car. So there's value in trademarks, and there's value in having an organized set of IP assets as well, is what I want to say.
Thank you.
Thanks. Thank you, Matt. So I like to consider, protection of IP in, I think this is Beaumaris Castle. Put a moat around your IP, build some castle walls, keep the real secret sauce in a keep in the middle of a set of concentric walls. Interesting enough, by way of value, the EUI, the European Intellectual Property Office, and the European Patents Office recently did a study, and they concluded that companies owning at least one patent, design, or trademark generate 20% higher revenues and pay 19% higher wages. It's difficult to say, well, just having one patent is going to cause all of the above. I think it's more about, as much about how you organize your business to identify your innovations, capture your IP, and then think about protecting and monetizing it is going to be what drives the difference in the business. So that's my slides on IP value. Any further questions, please ask forward. Now, next slide, I'm just going to move on to a quick summary of intellectual property. So we'll start a series of icons, a series of brands here. So I've just explained to you the Rolls-Royce, BMW, VW story there around about the trademark. I've got Coca-Cola there. It's one of the most valuable brands in the world, and the R in the circle is important, is relevant, because that illustrates that they consider Coca-Cola, that stylized logo there, to be a registered trademark. They've registered it in various jurisdictions around the world and will prevent others, therefore, from using that registered trademark. The $1 billion code, if nobody's seen this, Netflix, is a true example of sharing your intellectual property before you've got it protected. So a couple of brilliant German inventors developed Google Earth and unfortunately shared it. The story goes with, developed what became Google Earth. They then shared it with Google, and without protecting it with copyrights or patents and other forms of intellectual property, and Google went off and developed a business on the back of it, and the two inventors didn't receive anything. So the $1 billion code, a really good story, worth a look if you get time. I've got Gillette there. For me, at least until sort of 10 years ago, before the Harry's and Dollar Shave Club came along, these were a true example of intellectual property value. It was said at the time that they generated more profit from their razors than the US Treasury generated from printing dollar bills. I think that is relatively close to the truth, but they are an expert business at protecting every component. It's the best a man can get, of course, and there's famous sports people who will tell me that, but every component of their business with intellectual property. The handle alone, the King of Shaves, it's a business in the UK, he decided to go into razor blades, and it cost him £3 million just to get over the patents on the handle, Gillette's patents on the handle, never mind the blade, before he could actually go to market. So it's an example of generating value there, but it's also an example of why you should consider the landscape in the marketplace before you move into a particular domain. The buy with one click, I think most of us have used Amazon one click at one stage or another. That was patentable way back when, in 1997, when Jeff Bezos patented it. And because others wanted to use it, he was able to generate $2.3 billion alone from Apple through its 20-year life. Quickly then, TSMC, business most of us are using on a daily basis without knowing who they are. Taiwan Semiconductor Manufacturing Corporation has 9,000 patents, but it's their trade secrets they consider to be more valuable. That's where they protect their secret source and their trade secrets, and they claim to have 130,000 trade secrets. We talked about copyright royalties. The Roald Dahl family recently sold the rights to all of his images, to all of his content to Netflix for around about £370 million. And Netflix will, of course, build that into a whole franchise and a set of films. Perhaps a woeful tale, maybe not. Banksy has tried to stop an Australian greetings card company from using his intellectual property rights, his imagery, his designs, his pictures, and failed. And in part, he's failed because nobody knows who he is. And unless we know who you are and who the business is, then it's difficult to attribute the ownership to anybody. But also, he's played fast and loose with copyrights and trademarks in the past, and it's worked against him, unfortunately. So a bit of a woeful tale there. Next slide, please. So very quickly, trademarks, you can have the registered right, as in the R we saw with Coca-Cola, or the unregistered right. And not many people know that as long as you're not infringing on somebody else's rights, you can trade under your brand name in the UK without registering it, and you can claim unregistered rights. And there you can use the TM, the capital TM, after the name. And now I've told you that, you will start to see it. A registered trademark costs money, and you have to pay renewal fees every 10 years. But it's easier to defend. So should somebody infringe, you can point to the fact that you've got it registered. If you've got unregistered rights and somebody infringes or copies you, then it's a bit more effort to defend that name. Next slide, please.
Sorry, John, just another one that's come through that relates to trademarks. I thought relevant here. You may well have answered the question within that slide, but I will ask anyway. The question is, what unregistered rights are available in the UK? I suppose in addition to trademarks, which you've already mentioned, i.e. without paying a fee to the government.
Yeah, so my next couple of slides will cover that. So
Okay.
it's a really good point, and most people, it's a really good point actually, Matt. So thanks for asking. Most people, whoever asked that question, most people don't know that copyright is free to grant in the UK. You just need to claim, you just be able to demonstrate that you had ownership at a certain point in time. Hence with Roald Dahl, and here we've got Ed Sheeran. We've talked about trademarks. You can claim unregistered rights in your trademarks. Trade secrets is the next slide. That's an unregistered intellectual property right. I think it's one of the most valuable rights that nobody really knows about it. And then if we talk about trademark and brand, it's really important to consider your digital brand. So, and we'll come on to that in a second. So, websites and social media presence are really important, softer, but intellectual property rights that can be used to claim and prove that you have been using a brand, for example, for several years. Over time. So quite a lot that you can do without spending too much money. It's just the administrative aspects of gathering the data together and the proof points that you had. The Roald Dahl Giant Peach book, as of whenever it was published, 50 years ago or so. It's interesting with Ed Sheeran and copyright talk here that it varies in the UK from 50 to 70 years. Ed Sheeran now records every single recording session just to prove that to the creative process, because when he's selling a million copies or whatever it is, then people will jump on the bandwagon, as we've seen recently with The Shape of You in the High Court in London. It costs a lot of time and effort to defend. So making sure you've got the evidence to prove that you did develop that in the first place is really useful. Next slide, please. So trade secrets, not a lot of, everybody knows about confidential information. Very few people really understand the nuances of the trade secret law and how and why it can be important to you. So the Google algorithm is protected with trade secrets. The WD-40 recipe, the Coca-Cola recipe, the Kentucky Fried Chicken recipe are protected with trade secrets. You will have trade secrets in your business that will confer competitive advantage on your business. And it is really worth considering putting a few basic administrative steps in place to protect those trade secrets. They can be inventive. So before you decide to patent or not, you can protect your invention through a trade secret. It can also be commercially sensitive information. For example, something as simple as your client list and their contact details can be protected through trade secrets. So it's a really important right, something you'll see a lot more of in the next couple of years. And there've been some very high profile, recently a software case in the States where the infringer was fined $2 billion for stealing trade secrets. But you'll hear a lot more about this, believe you me. Next slide, please. So I talked about the digital brand, domain names, websites, marketplace. Why is this important from an intellectual property perspective? Well, it's really important to stake the claim in this real estate. If you're launching a product, for example, I would strongly advise that you make sure that you've got your new brand covered. Well, first and foremost, that you've got clearance to use the brand, of course, both digitally and from an intellectual property perspective. But then also you stake your claim by making sure you've got the social media handles registered for your brand, because it does confer unregistered rights on your name if you can prove that you've been selling on eBay using that, or Amazon using that brand, and or you are in a social media influencer. You've got 3 million followers on Instagram and somebody tries to copy you on TikTok. You can use the unregistered rights there of copyright and trademark to keep the copiers, the thieves, etc., the infringers at bay. Next slide, please. So moving on to the meat of today's presentation now, and patents. Clearly, most of you will know that a patent is something that's innovative. It has to be inventive. It has to be novel, i.e., in the terminology, there's no prior art. There's nothing else that's been published out there before that's similar to this invention. Useful and non-obvious. And of course, patents can be valuable. I just mentioned the Jeff Bezos patent. Glaxo just had a case in the States with Gilead, and their single patent will generate up to $2.75 billion in royalties and damages from Gilead for infringement. Dyson patented his bagless vacuum cleaner, took it to the market. Hoover copied it. He fought them over patent infringements and won, and the rest is history. Brompton, a really interesting point for me, at least. They have fought and won against counterfeiters for many years using copyright and trademark. And recently they've started to, they did register patents, but they expired, and then recently they've registered some more. And so as a nice segue to Caroline's talk, their single patent on a saddle height stop sleeve through the patent box generates them £200,000 per annum. And that will continue to do so for the foreseeable life of the patent, and the patent life is 20 years. So you can do the math to work out that's a really valuable addition to their business. So that's the end of my slides. We'll now open the floor in case there are any questions for me, and then we'll segue onto Caroline. But if anybody wants to follow up with me, please do so. You can find me on LinkedIn under John Pryor, or via my website exaltip.com, or I'm sure you can find the details from Claritas if you need to follow up. And if anybody wants to have a conversation as a client or an attendee today, I'm more than happy to give a free 30 minutes of my time to anybody to discuss your intellectual property.
Thanks, John. We've got a couple more questions that have come through as you've been speaking, so I'll read those out before we hand over to Caroline. So the first one is there any value in old expired brands?
Yeah, I think there is, and I think we can all think of old English brands, possibly like Dunhill, for example, that have been reinvigorated. And of course, there's a couple of sports companies in the UK that do an excellent job of reinvigorating old brands. But the one that came across my desk recently was Solomon Brothers Bank. I think it sort of was sold in 1997 on the back of a bit of a scandal. But it's been reinvigorated in the last couple of years. So although Citigroup owned it, they let the brand expire, and somebody's launched a financial services brand, a business using that brand. So I think there is definitely value in old brands. And there's a case about Procter & Gamble expiring the patents on I think it was called Dreft, a soap powder. And within a couple of days, Walmart had launched it as their own brand because they captured the whole brand equity associated with that brand that P&G had forgotten about. So yes, I think there is.
That's great. There's another one here about trade secrets that you'd mentioned. Obviously, they are important, and you'd put a few of those up on the slide. The question is, but why has nobody heard about them? How would you know about a trade secret, or is it obvious that you wouldn't, and therefore, how would you go about protecting it, I guess?
Yeah, great question. And the reason it's become a much more prominent right in the last 6 years, and primarily driven by governments, US, Europe, Japan, China, UK, have all revised their trade secret legislation in the last couple of years and are a lot hotter in terms of supporting people on trade secrets theft. It's easier for a court to understand a trade secrets case than it is a patents case, because if the jury has to understand the nuances of the claims of a particular patent, which might be incredibly complex, it's difficult. But to understand that there's been a theft of somebody's stolen something from somebody else is quite easy for any jury in the world to understand without getting into the complexities of it. And so it's increasingly valuable, but it's been used a lot actually to defend country level rights. So governments protecting businesses and industries from state-sponsored IP theft. But from a UK, but most people think they've got confidential information. Very few have developed that confidential information into a trade secrets program that can be defended in the courts of law, and it's not too difficult to do. I think education of the workforce is the most important thing, putting some processes and programs in place, because if people understand that they shouldn't be sharing this level of information, then they won't, and it's more likely to be retained within the business. And it really does come back to the weakness of IP and intangible assets, in that they flow and they spill quite easily. So having a trade secrets program that's understood by everybody in the business and they're contractually obligated to follow, I think is really important.
Okay, just a couple of quick ones. This one, there may be a bit of interpretation required, and it's probably difficult to answer without more detail, but it's the question is for a small owner-managed learning business, what are the sort of key things that should be protected or focused on from an IP point of view in that business? I guess another way of asking that is for a small business that maybe hasn't protected any of its intellectual property, where would you start? Where would you focus your effort?
Yeah, so I love that question, and the way I'd answer that is to go, well, sit down and have a session and ask yourself a couple of questions. What is your secret sauce? What is it that drives the competitive advantage in your business? And then ask it the other way and say, what is it that your competitors would most like to steal? Most like to take from your business to run and build their own business on the back of. And that will quite quickly get you to what's important in your business, be it software coding, algorithms, be it your brands, be it your designs, be it your content and your copyright. You will start to identify methodologies, ways of doing things. You'll start to identify what's really important, and then you start to go from there and say, well, how can we protect it? Trademarks, we said, copyright, design rights, patents, trade secrets, digital brands, etc. All are possible. And I think asking those questions, those fundamental questions, what is that secret sauce, and what would somebody most likely like to steal, will get you to the answer quite quickly.
Thanks. And then the final one, which segues nicely into Caroline's next section, is on patents. So how easy is it to get a patent in the UK? Cost, time, that type of thing.
I think in the UK, the UK Intellectual Property Office are constantly looking at ways of making IP a lot easier and a lot more accessible, and hats off to them. So in the UK, it's relatively straightforward, he says, with a slight sort of hesitation. Clearly, you've got to go through the steps of demonstrating that your invention is novel. So you need to do a novelty search. You need to identify that there's nothing else out there. And that takes a little bit of time, costs a little bit of money. And then there's the drafting of the patent, and then the sort of patent prosecution process, the turn and fro, possibly with the patent office. But it's, it depends on the complexity of the patent. A very narrow patent might be possible for £4,000, but you could easily spend £10,000 or even more in the UK, depending on the complexity, and you could probably get a patent granted within 2 years, depending on the technology and depending on the claims within that patent. But it might take longer, and it's different overseas. That's the complexity of IP. It might take you a lot longer in the United States. It might be 5 years, 3 to 5 years, maybe even longer to get it granted in the States, just because of the way it works over there.
Fantastic, John. Thank you very much for that. So without further ado, we'll hand over to Caroline to discuss the patent box and the tax aspects associated with that. Over to you, Caroline.
Hello, everybody. Hopefully you can all see me. My name is Caroline Walton, and I lead the Innovation Taxes Group at Claritas Tax. For the next 20 minutes or so, I'm going to talk to you about the patent box and patent box tax relief. I'm excited to be speaking to you about the patent box today, as I love innovation and I enjoy working with innovative businesses. The majority of companies that I work with pursue claims for R&D tax relief, and not all of those businesses own patents and are therefore eligible to claim patent box tax relief, unfortunately. This is a great shame, as the patent box offers significant corporation tax savings. Those that aren't interested in patenting are often deterred by a perception that the costs of patenting are unaffordable, or that patents don't really offer much in the way of protection, so they don't think that patenting is commercially worthwhile. Contrary to what many people think, the cost of patenting doesn't have to be extortionate. Obviously, John's just touched on a little bit about cost previously. Whilst it's true that if a business requires robust commercial protection in multiple jurisdictions, the cost of patenting can be very significant. A basic UK patent for the purposes of claiming patent box tax relief can be obtained quite cheaply, John's given a figure of about £4,000, which is right. I was going to say about 5,000. And in terms of timescale, I was going to say, it's possible to get quite a narrow UK patent in about 2 years. And obviously there are ways of getting patents more quickly than that if it has a green angle or an environmental angle. With the significant increase in the main rate of corporation tax next year to 25% for companies with taxable profits exceeding £250,000, it's my view that Patent Box is more important than ever and ought to be considered by all companies as part of their IP or financial strategy. Just in terms of how I came to meet John, a month or so ago, I saw a short webinar on LinkedIn, I think it was, in which John was co-presenting with somebody else on making the most of IP. And as part of that, I was really happy to see John speak about Patent Box and the fact that it's underclaimed by UK companies. And it was heartening to hear someone else share my own views, and that led me to making contact with John and organising this webinar. It has to be said that I've only got about 20 minutes, I think, to talk to you today. There are obviously time constraints, and there's so much about Patent Box to talk about, and you can't really condense it into half an hour. There's not enough time to consider all the intricacies of Part 8A of the Corporation Tax Act 2010. I'd probably send you all to sleep as well. So what follows is an overview, but I very much hope that it whets your appetite to get in touch and find out more afterwards. So next slide, please, Sam. So what is Patent Box tax relief? Well, the answer is that it's a UK corporate tax incentive scheme. It was introduced in April 2013, so it's been around for a little while now. And the aim of it is to encourage UK companies to carry out R&D activity, to commercialise their R&D efforts in the UK and to pursue patenting activity. It's a separate tax relief to R&D tax relief, but it does operate in harmony with the R&D tax relief schemes. Because it's a separate tax relief, the eligibility requirements to claim Patent Box are completely different to R&D tax relief, but both reliefs are there to innovative UK companies, and Patent Box is part of the government's growth agenda. The headline message of Patent Box tax relief is that the scheme provides for qualifying companies to pay only 10% on their relevant IP profits. That's a significant corporation tax saving. With the main rate of corporation tax being 19%, the preferential IP rate allows for an almost 50% tax saving, which is massive. And as I've said, with the main rate of corporation tax going up next year in April 2023 to 25%, then obviously the tax savings are only going to increase further. As with claims for R&D tax relief, it's possible to go back to previous accounting periods when making a claim. However, it's important to note that a claim can only be made when a company owns a granted patent or has an exclusive license over a granted patent. Having said that, the scheme does acknowledge that there is this time lag in respect to the time between filing for your patent and the actual grant. And to that end, the scheme does provide for roll-up relief. It's possible for a company to elect into the scheme for up to 6 accounting periods during the patent pending phase. And of course, once the patent is granted, it's possible to make a claim and to claim back the overpaid corporation tax paid during the patent pending period. Next slide, please, Sam. Just a slide here about take-up of Patent Box. As I indicated before, I deal with an awful lot of claims for R&D and tax relief, and a lesser number for Patent Box tax relief. And my experience is echoed throughout the accountancy and tax industry. Annual stats published by HMRC tell us how many companies claim Patent Box tax relief and the value. So the latest stats are in respect to the period 2018-2019, and they show that 1,405 companies made claims for Patent Box tax relief. 28% of those companies claiming are classified as large, and they make up 92% of the relief. More than 50% of the companies claiming are from the manufacturing sector, in particular the pharmaceutical sector. So if one contrasts those numbers with statistics for R&D tax relief, we see that it's significantly underclaimed. In respect to the year to March 2020, 85,900 companies claimed R&D tax relief, and of those, 76,225 were small and medium-sized enterprises. But this is a massive difference to the number of companies claiming Patent Box tax relief. And what's the reason for the difference? As I said, and from personal experience, a perception by companies that patenting is expensive, and as I've said, it doesn't need to be. Secondly, a perception that the actual relief is difficult to calculate by professional advisors themselves, and I wouldn't disagree with that, but it's okay when you know what you're doing. And thirdly, some confusion about the eligibility requirements, and that's fair comment, I think. Since the scheme started in 2013, there have been so many changes. There was the introduction of the R&D nexus fraction, grandfathering provisions, mandatory streaming. I think people don't know if they're coming or going. And I think all of those have contributed to the low take-up to date. But hopefully, as I say, that will alter going forwards. So next slide, Sam, please. So how to qualify for the relief? To be able to claim, you have to be a UK limited company liable to pay corporation tax. In addition, you must either own qualifying IP or hold an exclusive license over qualifying IP. So the meaning of an exclusive license is defined in the legislation, but broadly it means an agreement from an owner of qualifying IP to another entity granting rights. And rights to the exclusion of all others, including the owner of the qualifying IP that covers an entire national territory. In terms of what IP qualifies for patent box tax relief, no surprises in terms of the name of the scheme. We're mainly concerned with patents, but not all patents qualify. So the ones that do qualify are patents that are granted by the UK Intellectual Property Office, the European Patent Office, and also patents granted by intellectual property offices from specific countries within the EEA, and I've listed them on that slide. Noticeably, if you're a company that has a Chinese patent or a USA patent, unfortunately, you won't qualify for patent box tax relief. In terms of other rights that qualify, also patents that would have been granted by the UK IPO, but for issues involving national security, so obviously those patents not being published, they would qualify. And then there are other IP rights which are not patents, but nevertheless fall within the scheme. They include IP rights such as supplementary protection certificates, plant variety rights, and medical products which have either marketing or data protection. And the reason why those IP rights are there are because the process to register the rights is as vigorous as filing for patent protection in the UK. Please, next slide, Sam. So in terms of what else is necessary to be a qualifying company, so in addition to either owning qualifying IP or having an exclusive license, a company must have carried out what's called qualifying development in relation to the right. That means creating or carrying out a significant contribution towards the creation of the invention or ways in which it can be applied. Quite simply, this is a tax relief that's there to incentivize companies to carry out R&D activities. So patent box benefits are not available to passive IP holding companies. You have to do something with the IP in question. In the case of a group company, there's also something called the active ownership condition to satisfy, and that is satisfied in one of two ways. The first is by evidencing that a group company carried out qualifying development in relation to the invention which is patented, or alternatively that the group company carried out a lot of management activity in relation to the IP portfolio of qualifying rights. And in practice, that can be satisfied quite easily. It can involve activities such as decisions on renewing patents, decisions to grant licenses over IP and so on. Next slide, Sam. So in terms of the type of IP which qualifies for patent box tax relief, there are 5 specific heads of IP income which are classed as relevant IP income in the legislation. Head 1 is sales income, which is the sales of qualifying items. So those are inventions covered by the qualifying patent in question. Head 2, I've got this the wrong way around actually on this slide, but head 2 is license income and royalties. Obviously, John touched upon that. So if you're a company that owns qualifying IP and you grant a license to another entity and in return you receive license income and or royalties, then that is relevant IP income for purposes of patent box. Third head of income are the proceeds of sale. That's proceeds of sale from an outright disposal of the qualifying IP right. Head 4, damages for infringement in relation to the qualifying IP right, and 5 is other compensation that isn't damages for infringing IP rights. The legislation does acknowledge that a company can also earn other IP income during an accounting period from exploiting qualifying IP rights that doesn't fall nice and squarely within heads 1 to 5. And to that end, the scheme allows a proportion of that income to also be included in the patent box calculation, and that term is the notional royalty. Next slide, Sam. Just a few slides now, just in relation to certain aspects of IP income. Just particularly important to note is head 1, which is sales income. The sales income, the first head, it doesn't only include or allowed to be included the sales of products which are covered by qualifying IP. The legislation makes it clear that sales income also applies to the sales of items containing a qualifying IP right. So that's quite important here. So this can be very beneficial to companies in terms of sales income. And the example that I always cite to clients is the example of a car company, that a car manufacturer that is selling a car which contains lots of patented components. Sometimes the patented components in the car aren't worth very much money themselves on their own, but within the legislation, it's possible to include the overall sales income from the sales of a car, which is obviously far more significant. In addition, the legislation also allows to be included the sales of bespoke spare parts, where the purpose of the spare parts is to be either included in a patented product or included within a product containing more than one patented component. So here again, it's not necessary for the bespoke spare part itself to be patented. It might not be patented, but as long as it's designed to go into something that is patented, or in fact go into a product that's not patented but contains other things that are patented, then again, that the sales of bespoke spare parts, it can also be included in sales income. The other thing to note as well is that it doesn't matter where the sales income is generated. So for example, you could have a company that has a product that is covered by a UK patent, but that UK patent is sold worldwide. It's not just sales income in the UK that can be included in the patent box calculation. It's worldwide sales, provided that that sales income is reflected in the company account, in the UK company accounts for the accounting period in question. So that's really significant. So this head 1 is important. Next slide, Sam, please. License income, similar thing. It's really important that for any advisor, it's necessary to consider all license agreements granting rights over qualifying IP or qualifying items or qualifying processes. So a couple of examples here, what I mean. First example, Company X. Company X has 3 patents. 2 of them are qualifying IP rights and 1 isn't. The Chinese patent isn't a qualifying IP right. The Company X grants rights in respect of these rights to several companies, provided that all licenses are in respect to the same item, process as specified in the qualifying patent, then income from the licenses will all be relevant IP income. Second example, Company Y holds patents in the UK and overseas in respect of a product. The overseas patent wouldn't be qualifying IP, just the UK patent. Company Y grants a license to a subsidiary in an overseas territory to manufacture and sell the product in the overseas territory. All royalties will be relevant IP income, even though the right granted is for a non-qualifying patent. So very important if we're acting for a company with granting multiple licenses to look at all of them. Next slide, please, Sam. So just a few words about the notional royalty. So as I said before, there's 5 heads of relevant IP income, but the legislation does acknowledge the fact that there may be occurrences where a company earns income from exploiting patented IP, where the income is not one of those 5 heads. And the legislation acknowledges that that income should be classed as relevant IP income and attract the relief. In terms of examples where a notional royalty may arise, could be where a company uses a patented tool to manufacture and sell products that are not themselves patented, or where a company owns a process patent that provides a service. So the legislation allows a company to identify the IP income using any just and reasonable method. Having identified the income, one has to move on to attribute an appropriate percentage. And again, this is outside the scope of the talk today, but if a company qualifies for small claims treatment, 75% of the IP identified income could be included in the patent box calculation, but otherwise the appropriate percentage is calculated as per transfer pricing principles. And again, that's not for today necessarily. Slide 10, please, Sam. Okay, just a slide here about the mechanics of making a claim for those that aren't aware. So a company claims patent box tax relief by electing into the scheme. This means practically notifying HMRC in writing. No special form of words is required. It can be done in tax computations accompanying the CT 600. Doing a patent box claim, as you will imagine from what I've said so far, it involves a thorough analysis of a company's IP portfolio. It's necessary to identify all relevant income derived from qualifying IP rights. Once that's been done, there's a multi-step calculation, which I'll come to a bit later on, to determine the IP profits. And then there's the application of a mathematical formula to calculate what is termed the patent box deduction. The patent box deduction is the amount of profit attributable to qualifying IP rights that can be deducted from the annual taxable profit of a company to give rise to the patent box benefit. So in making a claim for patent box tax relief, a company still pays corporation tax at 19%, but the taxable profit is reduced by the patent box deduction. There's no requirement for a technical narrative. However, it is good practice to supply one to HMRC. I always do, in which I fully evidence how a company qualifies for the relief. It's, in my view, it's not good enough just to simply provide the calculation. I think it is crucial that an advisor explains how a company qualifies for patent box tax relief in terms of outlining how they're a qualifying company, qualifying development, active ownership, qualifying IP, and so on. Once elected into the scheme, a company has to perform the patent box calculation each accounting period. If a company wants to come out of the patent box tax relief scheme, it can do so, but it has to wait a number of years before it can elect back into the scheme. Timing about when to elect in is something that requires careful consideration and planning, and is something that I'm frequently called upon to do with companies. If a company elects in too soon when the IP is not profitable and returns a loss, there may be no tax benefit from electing in. That's self-explanatory. But if a company has already elected in, then there are rules in terms of what to do with the IP losses. If a company is part of a group and the individual company has an IP loss, then there's a requirement to set those losses off against other group IP profits, etc. So timing about when to elect in for the first time is something that does require careful consideration. Next slide, please, Sam. So just some FAQs. I don't know, I can't see the chat at the minute, and I'm going to answer questions after this webinar anyway. But always get asked questions about the difference between IP losses in patent box and general corporation tax losses. As one will appreciate, the calculation of IP profits required by the patent box rules will result in either a patent box profit or a patent box loss. If the IP is profitable, a company can go on to calculate the deduction from the company's annual taxable profits. If the IP is not profitable, the calculation will result in an IP loss. So an IP loss should not be confused with a normal corporation tax trading loss of a company. A company with IP profit either reduces a corporation tax profit or turns a corporation tax profit into a loss or increases a corporation tax loss. The patent box does not affect how a corporation tax loss is used. A company making a patent box election can still group relieve or carry forward its corporation tax loss at the full corporation tax rate in the usual way. If a company has an IP loss, as I've said, it will not benefit from the regime for that period. There can be no patent box deduction. The legislation prescribes how the IP losses should be treated. As stated, as I've said already, a startup company is unlikely to elect in until IP profits are generated. An already elected in company is obliged to set off the losses against IP profits in future periods or against IP profits of other group members if part of a group. Next slide, Sam. This is just a slide providing the steps that are currently required to calculate the patent box profits for a company. Very, very briefly, step one involves dividing the company income into relevant IP income and standard income streams. Mandatory streaming became compulsory last year, so all of the old rules don't apply anymore. Step two, you go further. So in respect of the relevant IP income stream, if you can, the company should divide that further into IP substreams. Ideally as per specific IP rights, but that's not always practicable, and in that case then it could you'd be required to stream as per products or processes or what is reasonably practicable. Step three involves allocating expenses to the standard income stream and to the IP substreams on a just and reasonable basis. Step four involves deducting those expenses and then also deducting a routine return from each substream. And then at that point, if the result is nil or less than nil, you stop. If greater than nil, you proceed to step five. That then involves deducting marketing asset returns for each substream. Step seven involves multiplying the amount of each IP substream by the R&D fraction, and step eight, adding in pre-grant income. If a company is actually elected into the patent box during the patent pending period, then the pre-grant income is added back. And then step nine involves calculating the patent box deduction, which involves application of a mathematical formula, which is on the next slide, Sam. I've just put, Sam, if you go next, which I've just put there. So the application of that formula provides what I've been talking to previously, which is called the patent box deduction. And that deduction is deducted from the trading profits to give a revised profit figure that is then subjected to corporation tax at the normal rate. I'm just looking at time. I've got 6 minutes to 2 o'clock, so we're almost finished. So I'm really sorry. I knew I wouldn't have time to give any real life examples of how patent box works in real life. I'm really happy to do that following this webinar for those that are interested. We can have a conversation after this in terms of whether people would like to have a separate webinar to go through some real life examples of how the patent box calculation works, or indeed anything else. And obviously I'm happy to answer specific queries from people about real life clients as well. Just in terms of my role at Claritas, in terms of patent box, it's not just about doing claims, as I've said during this discussion. I do obviously get involved with talking to clients about the appropriate time to actually elect into the scheme to take full tax advantage, but also with our R&D clients as well. I also have conversations with them about patenting, going right to the very sort of beginning of the innovation life cycle. And these are conversations I'm having more and more of now, especially with the increase in maiden rate corporation tax next year. More and more clients are looking at patenting. So if I have a client that's looking at patenting, then it's a case of having a conversation and then referring them to the appropriate patent attorney, etc. And I've got clients obviously who are looking at restructuring and to take full advantage of tax. And looking at ways of making their IP profitable, conversations like that with John. That concludes my discussion for this lunchtime. I'm going to hand over to Matt now to conclude.
Thanks, Caroline. Yeah, I think very much it would be really good to actually work through some of our sort of client examples of where the patent box has helped to massively benefit and reduce their tax bill, and also in many cases I identify where the IP is in a business in the first place and actually protect it through a patent. So very much I'm sure that will be a welcome follow-up to this, and we'll send details round. I guess this just leaves me to say, thank you very much for all those who attended today. We've had really good attendance again, which is good to hear. So, obviously we're doing something right in terms of the relevance of what we're presenting. Thank you very much to both John and Caroline for putting your time into this as well, and presenting today. You can see probably there for the final slide, we've got further webinars coming up during the year on tax dispute resolution, which is in old parlance tax investigations, and which is an ever moving world in terms of the revenue spotlight and how they're approaching inquiries into taxpayers' affairs. We then move on in October to property tax reliefs, which are incredibly relevant with the super deduction that came in recently and one thing and another. And then we've always got the budget to look forward to in November, and undoubtedly we'll be adding one or two further webinars to the agenda this year. Hopefully the one Caroline referenced there around patent box case studies. So the final thing is, yes, a question just popped up actually, which I was just about to answer. So yeah, the notes will be shared. We'll be circulating the slides and the recording as well. So that will all be circulated along with details of the follow-up webinars. So thanks all once again. Really appreciate your time, and enjoy the rest of your day. Thank you.